The government's latest GST reforms have brought good cheer to the insurance sector. Health and life insurance premiums are now exempt from GST. Until now, policyholders were paying 18% GST on their premiums. That is gone. Health and individual life insurance, from term plans to ULIPs to endowment policies, are now under the nil tax category. Now, in all my years of covering the insurance industry, this is perhaps the most impactful government incentive ever to have come to holders. So why was this needed? Because India's overall insurance penetration has declined to 3.7% in FY24 from 4% in FY23. Life insurance penetration has declined to 2.8% compared with 3% in FY23. Non-life insurance penetration has held steady at 1%. So what does this mean for policyholders? Will premiums come down on all insurance policies? Will insurers pass on the entire 18% cut to individuals? We try to get you the answers in this episode. It's Thursday, September 11. I am Shilpy Sinha. This is the Morning Brief. My first set of guests today are Kamlesh Rao, MD and CEO of Aditya Birla Sun Life, and Nilesh Sathe, former member of the Insurance Regulatory and Development Authority of India. I started by asking Kamlesh, when people buy life insurance after September 22nd, what should they expect?
So I think the government's intention is in line with its stated objective of insurance for all by 2047, specifically focusing on protection. So if you look at on term policies, GST used to be at 18%. Obviously on savings products, they used to be lesser, but still in the range of about 4.5%. Now making it zero, I think is a huge cost saving. And my view is across the length and breadth of insurance, policy buying, the cost of that will get cheaper for sure. And more specifically, in much needed protection, it will be significantly cheaper. Because that's where, like I said, the cost of GST was the highest. That it will cover entire gamut of all individual life insurance policies sold, I think was a welcome surprise.
Mr. Sathe, if you can come in here, India has been seeing a lower penetration for the last 2 years. Our penetration, which was 4.2%, has fallen to 3.7% now. What kind of boost do you see this exemption giving to the insurance industry?
Yeah, Shilpi, actually the penetration was not 4% for life insurance. It was less than 3% or almost around 3%. 4% was overall insurance penetration. And even 3%, not just 2 years, at least decade, it was around 2.7 to 3. Now the reasons for lower penetration are many. I will say one of the reasons was government unnecessarily loaded premium with 18% GST. The product became very costly in that case. And I will say that eliminating GST from premium is a good step in that direction. So there is a possibility that penetration may go up. But again, penetration will not go up just like that. There will be a lot of things required to be done. Like the number of agents have to increase, the number of bank assurance partners have to increase. Insurance is a push product. A lot of effort is to be put in while selling insurance, and that is why it is said that selling of insurance is one of the toughest professions in the world. So to sum it up, it's taken a bit late and it should have been taken earlier, and this will definitely help insurance industry to grow further.
Revenue Secretary Arvind Srivastav has said that the insurance companies have admitted that they'll pass on the benefits to policyholders. Now, what is the kind of benefit that policyholders should expect post this exemption kicks in from September 22nd? If Mr. Rao can come in here.
I think the insurance industry is committed to see whatever best pass out can happen. There are some implications on when insurance GST becomes zero, what happens to the input tax credit that insurance companies get. But there are issues around input tax credit because the exemption has happened on reinsurance premium. But there are costs related to insurance, whether it is servicing, issuance,
Yeah.
distribution costs that we pay, those still entail GST. And when the GST at the customer becomes zero, then input tax credit becomes a question mark. If it is taken care of, then we'll be able to maximize. And once we get the full picture, we will know whether the exact 18% get transferred or if everything remains the same as is today. And there is an impact of about give or take 4-5% in the area of protection. So will that have to be built in through some increase in price and the balance will get passed on? But like I said, these are all numbers right now and representations are going on. But the intent of the industry, regulation, as well as the council of all the members that we have is to see how can we maximize the transmission of the benefit to the customer.
And is there a study on how much hit it'll have on the margins?
It's very difficult. We are trying to put the number on
Yeah.
a basis put together. If you look at the input tax credit that we get, it is 100 rupees. Basically, a very small part of that is the reinsurance premium, which has been exempted from insurance. Roughly about only 15 rupees is the reinsurance premium. So we are thankful that reinsurance premium also has been exempted. 80-85% of the input tax credit is all the other costs of servicing, and a large part is on account of distribution costs that we have. So this input tax credit loss that will happen will have to get passed on in terms of some price increase. So at this point of time, it looks like, out of the 18, assuming in term prices, if 5-7% has to be adjusted, still 10-12% will get passed on. But if the input tax credit is taken care of in some fashion, then can 14-15% be passed on? That is something
Only
that we will know
10%.
only when we get.
Okay. Another thing, and I would ask Mr. Sathe to come in. Sir, if you can come in and explain how this impacts all the individual life insurance policies, and especially when you compare it with credit life policy, which is again an individual policy, but then sold as a group policy. What kind of impact those policies will have? And is there any kind of clarification being sought over there to treat credit life policies as individual as well?
See, the first thing, Shilpy, is the impact of removal of GST on insurance premium on insurance companies is not going to be much for new policies which will be sold after 22nd of September, because the premium can be revised. The major impact is going to be on the policies which are in their books, because they cannot increase the premium. Insurance companies are not allowed to increase premium once the contract at certain premium for a certain number of years. I'm going to cover you for some certain sum assured. This premium cannot be increased. So the companies which have a bigger book size will get impacted more because they cannot increase the premium. They can increase the premium only for new policies which will be sold. And for that, they can adjust also. But anyway, coming to the credit life, although it is a group policy, technically it is an individual policy. But then unfortunately, government has not understood. They have only said that group is not covered. But if representation is made and it is made clear to the government that this is not a policy where somebody else is paying premium, like take example of group insurance. Sometimes the company itself pays the premium. You don't give GST exemption, no problem. But where the premium is being recovered from individual employees or here individual borrowers, then it is as good as individual premium. So why not exemption? And this is something which needs to be taken up by the insurance companies immediately, because credit life is as good as individual insurance, but as of now will attract 18% GST, which is not beneficial to the policyholders.
Mr. Rao, has this been taken up with the government, and what are you expecting here?
So the fundamental structure of a credit life policy is based on similar groups, and therefore the pricing of that inherently has a larger benefit than the same person buying a individual term policy. So there are fundamental difference in those two structures. Typically, if somebody was taking a housing loan for say 50 lakh rupees and he would get a credit life cover say for the same amount, the price at which he would get that premium would be significantly cheaper than the price at which perhaps an individual would buy. So there are inherent benefits which are differently priced between a credit life and a individual life insurance policy. So the price changes. But at this point of time, on the individual side itself, the industry is saying we want to pass as much as possible. And we want to see whether we can get some benefit on the input tax credit structure. Otherwise, we will not be able to pass on. So right now, we have not made representations to add credit life. That's not the representation that we have at this point of time, because we file those products. We file it under group life insurance. And with the regulator, the filing, of course, happens as individual separately and group separately. And that's the communication just come. As long as you are doing an individual, GST is gone, group it is not gone.
What are the other ways by which the industry can bring down the premium? Can there be change in how they pay the agents, or tinker with other costs that there is?
If you look at the expense of management regulations which came 2 years back, the intention of the regulation also was to say that distribution cost needs to keep coming down, and the benefit of that will need to get passed on to the customer for sure. So assuming the distribution cost is 10 rupees, you want to bring it down, you can make it 8 rupees. That's not the debate. But the issue today is on 10 rupees, you are paying GST. On 8 rupees, you will pay GST. And the input tax credit on that 8 rupees at 18% will still hurt the companies. The expectation is obviously that as you bring your distribution cost down, that benefit anyway has to be passed on to the customer. And that's the expectation of the regulation also. So I don't know whether one will offset the other. But in all fairness, if from a regulatory point of view, also the intention of UA was to say, as your distribution cost keeps coming down, you should try and pass that on to the customer independently, and not because of any change in GST.
I'll add some different angle to this. Where a product is designed, there are three major assumptions which are made. In case of life insurance, it is mortality assumption. In case of health, it is morbidity assumption, which takes almost 75% of the total premium. Second is expense assumption. Third is interest rate assumption. And fourth is solvency margin and profit margin assumption. Now, there is a possibility that regulator may say that if you have loaded, say, 2% for your solvency, now you can reduce it to 0 or reduce it to 0.5. In that case, the insurance companies will be in a position to pass on more benefit to the customer. This is what regulator can do. Secondly, insurance companies also can squeeze a bit of their margin. Suppose they have loaded 10% profit. If 2% is to be passed on to customer additionally, they may squeeze it to 8% profit margin. In the process, with solvency margin and profit margin getting reduced, maybe instead of 12% being passed on to the customer, now there is a possibility that 15 or 16% may get passed on to the customer. So these are a couple of things which even regulator has to look into. See, all said and done, the customer is the king, and he has been benefited, no doubt about it. Because earlier he was buying 100 rupee product for 118. Now he will buy it for maybe 102, 105, 107, whatever it is. But in the process, he definitely has got a saving in any case. So it's definitely help the consumers.
The last question I would want to ask both of you is, ULIPs versus mutual fund. Since this relaxation has come on unit-linked insurance plans, do you think it has gained an edge over mutual funds now?
Kamlesh?
Mr. Rao, if you can go first, and then Mr. J. Yes.
I will answer this question. And, I don't think the GST is the bigger issue, because GST in ULIP was on charges. But to me, having done both mutual fund in the past and now as somebody who sells ULIP, I think the big difference between the two is the time frame.
No, they are on par, I will say. I cannot say they have an age. They have an age to the extent that mutual funds cannot cover risk on life. While in case of ULIP, necessarily insurance element has to be there. So in case of death of a person, in case of mutual fund, only whatever units are there, they get converted into rupees and that amount is payable. Here, in addition to that, because insurance cover is there, 5 times or 10 times of whatever premium is payable, or 105 times or 110 times of single premium. So obviously, in addition to that, in case of death, you get much more than what mutual funds would have given you. So from that point of view, this edge was already there. But because of removal of GST now, I think ULIP has become a more competitive product.
Now, what about health insurance? Is the impact on policyholders and insurers going to be different in this segment? I put this question to my next guest, Dr. Bhabatosh Mishra, COO of Niva Bupa Health Insurance.
This news, as you and most of your audience know, that it's a very big development. While the overall GST reform is great, but what has come is GST exemption on health insurance, particularly individual health insurance. How it is going to operate? Well, not everything is known as of now. There are more questions now about certain areas. Where would it apply? Where it would not? We know that retail health, individual health, family floater, it is applicable. But then there are areas like personal accident and certain other products. There are group products where consumers pay the premium themselves. And as we progress closer and closer to the date, we'll have all these questions answered. What we know of as of now is people who have purchase of health insurance, which is effective policy issuance and restart on or after 22nd of September, they would not have to pay the GST component of the overall premium, which used to be and which continues to be 18%, which is going to end from 22nd September, as we know. And this applies both to people purchasing health insurance policy only for self on an individual sum insured basis,
Yes.
or self and family members on individual sum insured basis, or even buying policy for self and family members on a floater sum insured basis. Significant moderation in overall premium, the premium a consumer used to pay for availing health insurance, is going to certainly spur the penetration of health insurance in India.
One confusion, I guess, that people have, and it's actually come from the industry, from the agents and distributors especially, is that it could be applicable before September 22nd. How are the companies dealing with this situation? Are people like coming up with demands, or are the agents trying to push for, say, a reduction in premium just now, that 18% reduction that they're going to see? Or are they like, selling products with a later date where they could avail of this benefit?
Well, first of all, we do not know it will be applicable before 22nd. So far, the stance of the relevant authorities, it is effective 22nd and onwards only. I think we need to look at it this way. There is generally a demand, and health insurance is not a very strong pull market, right? It's an advisory market where people want to understand. It's not a case of people lining up overnight for buying health insurance like they do when a new iPhone is launched, right? But yes, given the population for whom it is a discretionary purchase, people possibly would defer their decision to avail the benefit of exemption or waiver of GST, right? So as such, the demand from market, as we hear, as we notice, as we see, has certainly been impacted a little bit in the interim, because it is a discretionary purchase, right? From an advisor standpoint, yes, there are exploring options of, is there any possibility or is there any change that is likely to happen where they can sell and get exemption of GST even before 22nd, but that's something in the realm of speculation as of now rather than reality.
Other thing is that, the acquisition cost in health insurance is high. Without input tax credit, insurance companies will have to decide on how they structure the payment to the distributors as well. What is the kind of reduction in premium you expect for policyholders without this input tax credit?
Mathematically speaking, 18% GST waiver does not translate into an 18% reduction in overall premium. And depending on insurance company to insurance company, it could vary anything between 4% to perhaps in some cases 6.5% as well of a premium that would need to go up. But as far as I can talk about Niva Bupa, and as far as I know about many other insurers possibly, this is a very important step in achieving the goal of health insurance for all by 2047. And in that spirit, the entire GST impact of 18%, Niva Bupa for sure, and most likely the entire industry would pass it back to the consumer to start with. However, in the long run, not having input tax credit definitively changes a lot of things. It does put a bit of a certain financial strain on the overall bottom line, depending on the company. And it is to be seen how things will get structured. I'm sure insurers also would try to look at avenues how they can streamline their own purchases about
Mhm.
about various services and goods, because this is not happening just in health insurance. There has been moderation in GST in other areas as well. So the overall impact could also be a mix of that. However, that impact, in my opinion, is not strong enough to completely negate the impact of lack of input tax credit on the GST component.
Do you see penetration going up as a result of this exemption coming in?
No doubt I have in my mind. It is a measure which is instrumental at enhancing penetration of health insurance in our country. But that is just one of the impacts. I think there are several positive impacts other than that. For example, a big change should come in purchase behavior of consumers. Today, people buy smaller sum insureds because the budget may not allow adequacy of coverage, right? So a lot of times the premium is a consideration against a coverage that is affordable to the family. Now, I think what people should do and would do is they will start buying more adequate coverages. Similarly, comprehensive coverages like OPD plans.
Yeah.
Today, large part of the market is hospitalization product. But this is one very interesting step, which again creates a very, very fertile ground for purchase of outpatient products. Otherwise, this was one of the impediment in wider adoption of OPD plans earlier. That should become a reality. So it is going to have multiple positive impacts. Penetration certainly is a very important one, but that is not the only one.
Well, for families, especially seniors, health cover just got cheaper. For individuals looking to cover, life insurance becomes far more affordable. Experts say that while the GST exemption makes insurance premiums cheaper, it could hurt insurers because they lose input tax credit. Will they take the hit on their margins and pass on the entire 18% benefit to individuals buying cover? We will have to wait until September 22nd to know that. But in the bigger picture, this supports the government's ambition of insurance for all by 2047. At least this much is clear, that insurance in India is at an inflection point, and the sector is one step closer to being truly accessible. This episode was produced by Vinay Joshi, sound designed by Amrit Rechi. Do listen to the Morning Brief on Tuesdays, Thursdays, and Fridays, wherever you get your podcasts. Also, don't miss our brand new show, Corner Office Conversation, where we talk to the most interesting business leaders from India and the world, every alternate Monday on your favorite listening platform. This is your host, Shilpy Sinha, signing off. Have a good week.